Hi, it's the analyst from Think Like an Analyst, and today we're going to talk about Tesla. Now, I'm not the first person to say this, but at 600 times trailing earnings, Tesla feels expensive. Sure, the Tesla story is compelling, and their execution of late has been impressive, but still, what does 600 times earnings even mean, and how are we supposed to make sense of this number? Well, the answer is that you have to go back to the basics and look at the fundamentals. Specifically, it means trying to put some actual numbers to the story so you see what it all adds up to. And the best way to do this is with a model. Let me show you what I mean. We've built a very simple model for Tesla to see if we can make sense of its valuation. The model is very simple and has just three forecast variables. That is revenue growth, after-tax operating margins, and capital turns. These three variables are all we need to do our analysis. What we've specifically set out to do in this model is to try to find what kind of financial performance Tesla would have to deliver in order to justify its current share price. This means playing with the forecast variables until I get to $600. So let's look at the numbers. As a starting point, I've taken the last reported financial metrics and carried them forward into the future. Notice that at these levels, the model suggests that Tesla is not worth anything, because although Tesla is growing very rapidly, its returns are too low, and therefore its growth does not have any value. Now obviously the market believes that Tesla is in fact very valuable, and so by definition, the current share price has embedded in it an expectation about future performance. So let's play around with the numbers to see exactly what the market expects of Tesla. To start, let's just plug in the consensus revenue forecast for the next 2 years and then take it from there. Note that the consensus revenue estimates for Tesla are $49.1 billion for 2021 and $65.7 billion for 2022. This is extraordinary and represents growth rates of 55% and 34% over the next 2 years. Now these growth rates don't seem sustainable, so beyond 2022, I'm going to trend revenue growth rates down to 20% per year and then carry this forward. Okay, now in terms of margins, Tesla has seen steady improvement over the last few years as it scales up, and there's no reason to think that they can't continue to improve margins further. Tesla is, after all, a premium brand and commands premium pricing. Nevertheless, the EV space is attracting a lot of new players and a lot of new investment, and this will likely put a cap on Tesla's margin expansion into the future. For modeling purposes, our NOPAT margin variable is our key lever, so we'll need to ramp this up very aggressively to hit our $600 target. Tesla's NOPAT margin is currently around 5%. So let's gradually trend this number up until we hit our target of 600. Make 6, 7.5%, 10%, 12.5%, 15%, 18%, and there we are. We've now pretty much matched the model valuation with the current share price. This means that our forecasts pretty closely match market expectations for Tesla's financial performance into the future. Now we should refer back to our comps as a reasonability check on our forecasts. The comps we've picked aren't perfect, but you'll notice that at 18%, Tesla's NOPAT margin would be well above where it is today and well above industry benchmarks. You'll also notice that our forecasts generate a return on invested capital of almost 32% at its peak. Again, well above where it is today and well above industry standards. Now you may argue that Tesla is not just another car company. It is more like a tech company. And that may be true. But don't forget that you still have to translate that perspective into a set of numbers that make sense in your model. So what does it all mean? Well, I'm not going to take a view here. and I'll let the numbers speak for themselves. Again, the purpose of the exercise was to see what kind of financial performance Tesla would have to deliver in order to justify its current share price. I'll let you decide whether you think the forecasts are reasonable or not, and then by extension, whether you think the current share price can be justified. In the meantime, I've put a link to the model below, so check it out and play around with the numbers for yourself. And as always, go ahead and leave questions and comments below. Happy modeling.